High-income earners can lose up to 37% of their real estate gains to taxes, but with the right strategies, you can keep a significant portion of that money in your pocket. In this video, discover how to use advanced tax tactics to protect your wealth and maximize your real estate investments. Let us understand the tax basics for real estate investors. When diving into real estate as a high-income earner, it's crucial to understand how taxes impact your investments. The more you earn, the higher your tax bracket, which means a bigger slice of your income goes to the IRS. Real estate income can push you into even higher tax brackets, making it essential to grasp how different types of income are taxed. Active income comes from direct work, like rental management. Passive income flows from rental properties you aren't actively managing, while capital gains are profits from selling a property. Each income type is taxed differently, affecting your overall tax bill. Depreciation is another key factor. It lets you deduct a portion of your property's value each year, reducing taxable income. Combine this with deductions for expenses like mortgage interest and property management, and you've got powerful tools to lower what you owe in taxes. Understanding these basics is the first step in protecting your earnings. Now let's talk about how you can maximize the benefits of depreciation to reduce your tax. Maximizing depreciation benefits. Depreciation is a powerful tool for real estate investors, especially high-income earners. It allows you to spread the cost of a property over its useful life, letting you deduct a portion of its value each year. This deduction reduces your taxable income, meaning you keep more of your money. To maximize these benefits, consider a cost segregation study. This technique breaks down your property into various components like the building, landscaping, and fixtures, which can be depreciated at different rates. By accelerating the depreciation on these items, you can claim larger deductions earlier, providing immediate tax relief. Bonus depreciation is another key strategy. Current laws allow you to deduct a significant portion of certain property improvements in the first year, rather than spreading it out over many years. This is especially beneficial for high-income earners looking to reduce their taxable income quickly. Finally, the Section 179 deduction offers another way to write off the cost of qualifying property, such as equipment or furniture, in the year it's purchased. By understanding and using these strategies, you can significantly lower your tax burden and enhance the profitability of your real estate investments. Once you've leveraged depreciation, it's time to explore how a 1031 exchange can help you defer capital gains taxes on your real estate sales. Let us now talk about how 1031 exchange can be used to defer capital gains taxes. A 1031 exchange is a smart strategy for real estate investors to defer paying capital gains taxes when selling a property. Instead of selling a property and immediately facing a hefty tax bill, a 1031 exchange allows you to reinvest the proceeds into a new, like-kind property and postpone paying those taxes. This can keep more of your money working for you. Here's how it works. You sell your investment property and then have 45 days to identify a new property and 180 days to close on it. The key is that the new property must be of equal or greater value, and both properties must be used for investment or business purposes. By rolling over your gains into the new property, you avoid paying capital gains taxes immediately. However, the process is strict. Missing deadlines or failing to meet requirements can result in losing the tax deferral. That's why it's essential to work with professionals who understand the nuances of 1031 exchanges. For example, if you sell a rental property for $500,000 and buy a new one for $600,000, you defer the capital gains tax on the $500,000 sale. This allows you to reinvest and grow your portfolio without an immediate tax hit. But deferring taxes isn't the only strategy. Becoming a real estate professional offers even more tax advantages. Being classified as a real estate professional under IRS guidelines can offer significant tax benefits, especially for high-income earners. To qualify, you must meet specific criteria. First, you need to spend more than 750 hours per year actively involved in real estate activities. This could include managing properties, overseeing repairs, or handling tenant issues. Additionally, these activities must make up more than half of the personal services you perform in all trades or businesses throughout the year. The big advantage of qualifying as a real estate professional is the ability to offset your active income with real estate losses. Normally, passive losses from real estate can only offset passive income, but with this status, those losses can be used to reduce your taxable income from other sources, potentially lowering your overall tax bill. To meet these qualifications, careful time management and documentation are crucial. Keep detailed records of your hours spent on real estate activities and ensure that you can prove material participation. This might mean setting aside time regularly to engage in real estate tasks and keeping logs or calendars to track your involvement. By achieving real estate professional status, you can maximize the tax efficiency of your real estate investments. Achieving real estate professional status can also enhance how you strategically use passive losses to optimize your tax outcomes. Strategic use of passive losses. Passive losses occur when expenses from real estate investments exceed income from those properties. For high-income earners, these losses are typically limited, meaning they can only offset other passive income, not active income like wages. However, under certain conditions, real estate losses can offset active income, especially if you qualify as a real estate professional. The IRS has strict passive activity loss (PAL) rules to prevent high earners from using real estate losses to significantly reduce their tax bills. Still, there are strategies to navigate these limitations. For example, carefully timing the sale of a property to trigger passive gains can unlock the ability to use those losses. Also, grouping multiple rental properties into a single activity might help in meeting material participation requirements, making more losses deductible. Understanding these nuances allows you to strategically manage passive losses and optimize your tax situation. Speaking of optimization, let's explore how LLCs and trusts can offer both protection and tax benefits for your real estate investments. Leveraging real estate through LLCs and trusts. Using an LLC to hold real estate offers both liability protection and potential tax benefits. An LLC shields your personal assets from legal claims related to your property, making it a popular choice among investors. Additionally, LLCs can offer flexible taxation options, allowing income to be passed through directly to your personal taxes or taxed as a corporation, depending on what's most advantageous. Trusts are another powerful tool, particularly for estate planning. They help ensure your assets are transferred smoothly to your heirs while potentially minimizing estate taxes. Trusts can also provide privacy and control over how your real estate is managed and distributed. Combining LLCs with trusts can maximize these benefits. For instance, placing an LLC within a trust allows you to protect your assets, reduce tax liabilities, and ensure your real estate investments are managed according to your wishes after you're gone. Beyond traditional structures, investing in opportunity zones can provide significant tax incentives while supporting economic development. Investing in opportunity zones. Opportunity zones are specific areas designated by the government to encourage economic development and job creation in distressed communities. These zones were established as part of the Tax Cuts and Jobs Act of 2017, with the goal of driving long-term investments into underdeveloped regions. Defer paying capital gains taxes by reinvesting those gains into a qualified opportunity fund that targets projects within these zones. The deferral lasts until you sell the investment or until December 31st, 2026, whichever comes first. Additionally, if you hold your investment for at least 5 years, you can exclude 10% of the deferred gains from taxation. Holding for 7 years increases this exclusion to 15%. The real potential lies in the long-term growth. If you keep your investment in the opportunity zone for at least 10 years, any appreciation in value is completely tax-free. This combination of deferring taxes, reducing the taxable portion of your gains, and eliminating taxes on future appreciation makes opportunity zones an attractive option for high-income earners looking to grow their wealth while contributing to the revitalization of economically challenged areas. Finally, let's look at how strategic charitable giving and timing your real estate transactions can further enhance your tax efficiency. Strategic charitable giving and timing for real estate tax efficiency. High-income earners can strategically use charitable contributions and timing to optimize real estate tax outcomes. Charitable remainder trusts, CRTs, are a powerful tool to offset real estate gains. By placing appreciated property into a CRT, you can defer capital gains taxes, receive a partial tax deduction, and provide income to yourself or your beneficiaries over time, with the remainder going to charity. This not only benefits a cause you care about, but also reduces your taxable income. Donor-advised funds offer another effective strategy. By contributing cash or appreciated assets, including real estate, to a DAF, you receive an immediate tax deduction while allowing the fund to distribute donations over time. This approach is especially useful for managing large gains and maintaining control over charitable giving. Timing real estate transactions is crucial for maximizing tax efficiency. Selling a property in a lower income year can reduce the impact of capital gains taxes. Additionally, year-end tax planning allows you to align property sales and purchases with favorable tax conditions. For instance, completing a sale before year-end can lock in current rates, while deferring a purchase might push expenses into a more beneficial tax year. Combining these strategies helps manage tax liabilities while supporting your financial and philanthropic goals. How will you use these strategies to keep more of your real estate gains? Drop a comment below, like, share, and subscribe for more tips, and don't forget to hit the notification bell so you never miss an update.